A new era for gold. Prices break all records. Gold prices surged in 2026. The metal's value climbed to historic heights. This move surprised many people. It also created a lot of concern in global markets. The price per ounce went past $5,000 for the first time ever, even touching $5,555 in some reports. A huge change in a short period. The price gained 100% in just 12 months. This rapid appreciation has major implications for investors, and for central banks, and for the global financial system. It signals a deep shift in how people view money and safety. The main reason for this dramatic rise is a loss of trust. The central bank buying spree, a structural shift. Central banks have become huge buyers of gold. For several years, they've been adding massive amounts to official reserves. That trend continued at a very strong pace in 2026. In Q1 alone, central banks added 244 tons, higher than the previous quarter and well above the 5-year average. This steady, large-scale demand provides a strong floor for the gold price. It creates upward pressure that is hard to counter. Persistent buying has changed how gold behaves, breaking its old link to real interest rates. Central banks are buying for strategic reasons. They want to diversify reserves away from the US dollar, seeking a neutral asset not controlled by any single country. This buying is not sensitive to interest rate changes. China and India are actively buying to reduce dollar dependence. Investor rush. ETFs and retail demand fuel the fire. It's not just central banks. Individual and institutional investors are using exchange-traded funds. Gold ETFs let people invest without holding physical metal, but inflows force funds to buy bullion. In 2025, inflows hit a record $89 billion. AUM doubled to $559 billion. Holdings reached 4,025 tons. The trend continued into 2026, with forecasts of another 250 tons of ETF inflows. A self-reinforcing cycle that pushes prices higher. Retail investors are buying physical gold at a record pace. The World Gold Council reported a 42% jump to 474 tons in Q1 2026. People see rising prices and uncertainty and buy gold to protect savings. Total demand value hit $193 billion, up 74% year-on-year. When many buyers chase a limited asset at once, the price can only go one way, up. The value of the US dollar has a strong influence on gold. They often move in opposite directions. A weaker dollar makes gold cheaper for non-US investors and boosts demand. In 2026, concerns about US fiscal policy and political interference in the Federal Reserve added pressure. This currency effect provided a tailwind for gold throughout the year. Political risk was a major factor. Market destabilizing moves by the US administration upended relations with key partners. Operations in Venezuela and actions against Iran heightened a global crisis mood. An energy shock tore up the rate cut outlook. During conflict, investors flocked to safe havens, gold foremost among them. Domestic probes and shutdown worries eroded institutional trust. Many decided assets tied to US politics were too risky. Gold offered an escape. One of the most important factors is limited supply. Unlike paper or digital assets, gold cannot be created out of thin air. It must be dug out of the ground. Long, difficult, expensive. Even at record highs, supply cannot increase quickly. Supply inelasticity forces prices sharply higher when demand jumps. Bringing a mine online takes years of exploration, permitting, and infrastructure. From discovery to first ounce typically takes 10 to 20 years. Easy deposits are gone. New finds are remote, riskier, and often lower grade. Lower grades mean more rock, higher costs, slower response. Miners simply cannot deliver fast enough. Above-ground stocks, vaults, and jewelry are tempted back only at higher prices. Analysts say prices can keep climbing because there is no quick fix. Fast demand versus slow supply drives a parabolic market. Demand from Asia, particularly China, has been a powerful engine. In Q1 2026, China surged 67% to a record 207 tons, well above the 2013 peak of 155. Wealth preservation and policy initiatives created deep, sustained appetite. This structural demand is a key pillar for prices. Technology demand edged 1% higher to 82 tons in Q1 2026, smaller, but steady and important. Major banks turned bullish. JP Morgan up to 6,300, UBS 5,900, Wells Fargo 6,001 to 6,300 with a bull case to 8,000. BNP Paribas raising its outlook above 6,000. These forecasts shape big money expectations and can become self-fulfilling. Strong Asian demand, steady industrial use, and bullish sentiment create a very positive backdrop. In summary, gold surged in 2026 for clear reasons, not speculation alone. A fundamental loss of trust triggered a massive flight to safety. Central banks led historic buying to diversify away from the dollar. For investors, a small allocation to physical gold or a physically backed ETF can serve long-term wealth preservation.